Hello, everyone. Welcome. I'm Ross from Hive Business. Really pleased to welcome again David Abel from Vision Dental Wealth. Welcome, David.
Hi, Ross.
Hi there. Thanks. Um, what I'd like to kind of discuss today is whether our kind of dental clients, whether they can actually get by without you, basically. So, I know, I know you do a great job. I know, there's fees for your IFA to do that, but can or should clients do their own kind of investing? I know it's particularly easy to set up, a stock or an investment app on my phone, put some money into it, whether that's from my personal pocket, maybe it's from my kind of my limited company, and we'll get the right kind of tax advice on that as well. But you know, could I do it myself and save your fees?
Yeah, great question. Great question. It's a question we get a lot as well. And if you look at a lot of forums, it's kind of why you're paying these advice fees, and a lot
Yeah,
of DIY investors that
yeah,
manage it themselves. And I think there will be a small percentage of people that will manage to get through their whole lives, maybe DIYing. The issue there is they don't know what they're missing out on in
mm,
terms of tax planning. And when you grow more wealth, uh, you definitely need more planning just because of the tax burden. I mean, you will have seen some horror stories with some clients that have come to you, and you need to do a lot of organising. It's incredibly difficult to manage because it's such a complicated system. And
yeah.
the way I always think about it, and I've got a friend that doesn't believe in dentistry. He thinks he thinks it's a con. He thinks that you don't need to go to a dentist, and he just brushes his teeth. He's kind of never been to one since he's been an adult, and he's been all right. And he might skate through his life not needing one, but he doesn't know the damage he's doing potentially, and he doesn't know what that the impact of missing out on that oral health has been. And
Mm.
there might be a situation where 5 years time he had something seriously goes wrong, and then he
Yeah,
has to call in a dentist, and probably his options are going to be limited as to what treatment that he can have just because of the
yeah.
damage. It's probably going to be expensive as well.
But I mean, I imagine as well he's missing out on potential elective treatment as well. So I don't know who your friend is, but maybe he's got really stained teeth and they're wonky and crooked all over the place.
Well, I won't name him. I won't name him. But yeah, so it could be like that, and that happens with some DIY investors. They'll kind of go through life, kind of just investing as long as they're consistent and don't make mistakes, which is very hard to do. Just stick to an investment strategy over the long term,
Yeah,
especially with the amount of noise out there at the moment. I mean, at the moment, there's obviously there's cryptocurrencies, which there's many of them. Gold's really popular right now because of the massive march on gold. And the
yeah,
issue is if you're switching all the time to things that have performed well, usually that performance doesn't continue. So it'll
yeah,
go in a cycle. So if you're switching based on good performance, and there's actually a really good case study for this. There's an investment fund manager called Peter Lynch who used to work for Fidelity,
yeah,
and his average annual return. He was an active manager, so he's pick and choosing stocks. His average annual return was 29% over about 10 or 11 year period. But
yeah,
the average investor only saw 3% of that. And that's because the volatility was so extreme
yeah.
that they were selling out at the bottom and buying at the top.
That's just the classic kind of, what you want to do is buy low and sell high, don't you? But that requires way more kind of skill and art than you might ever imagine.
Exactly, exactly, and it's contrary to everything else. If you're buying a car, if you whatever you're buying, you're looking for the best price, or if you're selling something, you want to sell it for the most money. So it is strange how the psychology works with investing, but avoiding mistakes. If you can manage to do that over a 30-year period, then you'll
Yeah,
be in a very very small minority. So I think the people that are kind of saying they just don't want to pay the fees maybe haven't seen the value or the right advisor, because there are some advisors that kind of will set up an investment strategy and kind of sit back and just check in every now and
yeah,
just talk about the markets, and don't really focus on forward planning, don't really focus on your life and alignment with the tax advisors like yourself.
yeah.
I think that does happen. I'm not saying they're not out there, but most financial planners will will add value, and they will generally only work with people they can feel they can add significant value to.
Yeah.
Um, because the fees, there's no tie-in period. If a client wants to leave, then they can just switch off the fees, and as of yet, none of our clients
Yeah.
have left because we believe we can continually add value over a long period.
Yeah, it's like I definitely think there's this element of you kind of self-rationalize as well. So if you do choose to DIY it and you do choose to kind of buy the stock of the day, a bit like magpie investing, really, isn't it? It's like,
Yeah.
well, I've heard good things about Tesla at this moment in time. They're going to build robots and whatever it might be. It's not financial advice, by the way, but you do get stuck into it. And if it goes down, you go, well, and you kind of just give yourself a get out of jail free card. Whereas it's probably, well, yeah, I think you kind of it's great that you kind of assume the responsibility for your kind of own wins and failures, but wouldn't it be better if you just didn't fail so much? And I think that's probably a little bit of what you're trying to articulate. It's you're not trying to kind of get the 10Xs or anything like that. You're trying to capture decades or 100 years worth of evidence.
Yeah, that's it. That's it. And the main one's avoiding mistakes. If you can do that, and what a lot of our clients don't have is time. And these other investments, they require quite a lot of time to look into. If you've got a lot of money, hundreds of thousands, if not, seven figures invested in something, you're going to want to monitor it very closely. Well,
Yeah,
my clients just don't have the time to do it, and that's another reason they get us involved. Just
yeah,
so they feel they've got peace of mind that someone's looking after that full time,
yeah.
and they know what they're doing.
I think that the irony is that multiple things can be true at the same point in time. So I know for years they were saying, well, passive index funds, they're really cheap. Why do you need to pay for anything more than that or financial advice? Here's my facts, here's my maths. If this fund grows and there's no fees involved, it grows higher. Like that is true. I
Yeah.
mean, other than the fact I wouldn't know which index fund to pick in the first place, because there's about, well, I was going to say 100 index funds. There's probably thousands of index funds. So you kind of fail at the first hurdle to a certain extent, and then maybe you kind of end up putting it all in Tesla. I haven't invested in Tesla. I would emphasize that, but do you know what I mean? Like ironically, there can be someone somewhere who makes a very good case that mathematically low cost funds are a really good thing. Keep your kind of costs down, and it compound kind of has a good effect.
Yeah.
But kind of the framework you've applied on it, if an IFA is charging you a modest fee every year, that suddenly seems like an absolute bargain because you can get on with your day job, and you're going to experience kind of less volatility and less of those kind of car crashes.
Yeah, and if you value your time, it's how much money do you put on your time as well. And funnily enough, that I was just thinking when you were saying that, those type of people, they surround each other, so you'll get the confirmation bias as well. And there's the FIRE movement. I don't know if you've heard of it. It's financial independence, retire early, where they will just they'll kind of don't have advisors. They'll just keep their heads down. They'll be really shrewd with their spending. They won't spend anything. They'll invest in index funds and they'll try and retire by, let's say, 35 or 40.
Right.
The issue with that is, that they're obviously not, my view on that is they're not living their lives. If they're not enjoying their lives and they're not spending the
Uh,
money on the trips and creating those experiences, if they die when they're 40, when they've got enough money, what's the whole point? So that's again where I feel that the biggest value we really add is challenging our clients to say, well, are you happy with what you're doing and how you're spending your
yeah,
time? And a lot of that will be, we get all sorts in terms of the amount of clinical work. Some will say, I don't want to do any clinical work. Some will say, I want to do more. That's what I enjoy doing. I don't want to do the business side. So
yeah,
it's just challenging to say, okay, what do you want to do? Let's pick out that dream lifestyle. What's the dream week look like?
yeah,
And then working with yourself and Dan to try and help facilitate that transition and make sure it's
yeah,
going to be profitable, and if they need to get another surgery or whatever that looks like. But
yeah,
I would say I feel like that's the biggest part of our value.
yeah. Well, I think, well-meaning advice is well-meaning and you should definitely soak it up. But I think one of my kind of takeaways is there's no substitute for a kind of a specific plan for an individual circumstances. And, that does require that kind of interaction.
Yeah, definitely. And I guess there's one other point to mention, which is a kind of one-off transactional advice, which is something we rarely do. And I'll kind of give you a case study to why. Um, and it's basically around the amount of change there is in the tax system.
Mm.
We could put together an inheritance tax plan, and again, I got proposed by a client to do this, and it was putting in a strategy, 21-year strategy for gifting with investment bonds and trusts and that type of thing. Uh, and if I would have put that in place, I've done that many times for existing clients, and we continually monitor it. But if I would have put that in place when they change the pension rules, which are going to come into effect in 2027, and there's over seven figures in the pension, that plan's completely out the window. We've not mitigated the tax because the rules have changed.
Yeah,
And I've got a feeling that's going to continue over the
yeah.
kind of short term, at least. So that's why the ongoing position is really important.
Well, much like a dentist take cares of his patients or his or her patient's teeth, there's the same element and theme in financial advisory, as there is in tax and business advisory as well, to be honest with you.
Yeah, definitely, definitely.
Great. Thank you very much for your time and help explaining that. Actually, that was really, really helpful. Anyone has any queries, please do get in contact with either Hive or Vision Dental Wealth. We'd love to hear from you. Thank you.
Good stuff. Thank you.